For more right now on U.S. and China tensions, let's welcome Ruchir Sharma. He is Chief Global Strategist and Head of Emerging Markets with Morgan Stanley Investment Management. And what do you think, Ruchir? This is a situation where things are ramping up on both sides, both with China and the United States, and then China and Hong Kong, too.
Exactly. So when I was on your show last time, a couple of weeks ago, I was talking about the fact that what this crisis has done is accelerated many trends that were already underway before the crisis, rather than sort of turning the world upside down. I think that this has become now Exhibit A of that. This is all about U.S. China tensions being ramped up, and this is another sort of indication of that, a series of things which have happened over the last 24 to 48 hours to suggest that. So I'm not sure when this law gets implemented or if it gets implemented. They've tried it in the past, I think it was in 2003, and then pulled back on it. But I think that in general, the bigger story here is that these tensions are sort of just getting ramped up. And as we head into the election, we're just going to hear much more of this, even if there's no immediate action, even on this whole delisting story of the ADRs. These are all long processes things. These are not events. But I think that the direction is clear, and obviously a new sort of element for all of us investors to consider as the year plays out.
We are looking at the futures down by about 103 points today. The Dow, all the major averages were down yesterday as well. And I think a lot of people are pointing to these amped up tensions with China as a big part of that reason. I realize this is a long, slow-moving issue, but you do have bipartisan support for this, Democrats and Republicans saying that they want to be a little tougher with China. What does that mean longer term?
Well, I think that we are back to the era of a new Cold War, in terms of the fact that this is the new tech Cold War, really, centered on this. And so you have much higher geopolitical risk premium, which needs to be reflected in assets. And I think that's what's going on. But now it's possible that after the election, some of this cools down a bit. But I think the trend is pretty clear in terms of what happens. And the only thing which can prevent something from escalating further is the fact if the economic consequences become apparent. So last year, that's what happened, that the U.S. and China sort of calmed things down because it was very clear that the economic consequences were quite negative. But given the mess the economies are in, I think that, sort of politics trumps economics in an environment like this.
Which means what? I mean, if we're already talking about economies that are basically in free fall, in both here and in China, if this gets ramped up, what are the negative implications, and what would you be telling investors to do right now as a result?
Right. I think that the biggest sort of fear I have currently is there's so much crowding of positions in a few of these stocks, which is particularly in these leading Chinese ADRs and, of course, in the U.S. tech stocks, that I think that their relative performance in particular is at risk with what's going on. In fact, if you look at the last couple of years, every time you had a major escalation in U.S. and China tensions, that's the only time when these very strong secular growth performers have taken a hit. And I think there's a lot of crowding in there. Sentiment is excessively bullish in the Teflon-like ability of these companies to keep growing. And I think that is what sort of is at risk more than anything else in the coming few months. So just like in the U.S., you've had this phenomenon where 5 or 6 stocks, the big FANG stocks, have totally dominated the earnings and the relative return profile in the U.S. Similarly, in the emerging markets, it's these 5 or 6 stocks led by Tencent, Alibaba kind of names, which have completely dominated the return profile. So I think the excessive crowding in these particular stocks on both U.S. and China, and these stocks which are very exposed, I think, to the deglobalization trade, I think those risks become apparent, and I think that's what we're seeing on a day like today as well.
Last week the Chinese government was fairly explicit in its messaging that it sent through one of the newspapers or one of the media organizations there that's very close to the Chinese government, kind of a mouthpiece for them. They were very clear in messaging that it was going to be Apple and Boeing and other stocks that directly took a hit, that China would stop buying Boeing planes, that they would stop being maybe working so closely with Apple and allowing them to go back and forth. Are those particular stocks a concern for you? You think they carry through with that?
I think that, I think so. I think that, it's sort of a bigger theme that I've been speaking about, the end of the era of multinationals, which is that these companies, which have too much geographical spread, I think that there is a risk in terms of what happens to them. Now, of course, these things are not going to change overnight. No one's going to withdraw from China or like their global footprint. But I think that it is the sort of big risk to multinationals. So, yeah, so those stocks that you mentioned are also the kind of stocks that I'm talking about, that where is the excessive crowding in which has happened this year as far as positions are concerned. And this event is a direct threat to those excessive crowding in which has happened. If you look at all the hedge fund baskets, you look at the retail investors, where there's been such an explosion in new retail trading, they've all been buying the same handful of stocks in terms of the super popular FANG stocks and the very big Chinese ADR. So I think that's where I see the big risk, and an event like this only accelerates that.